G'day H, how you going?
Morning, mate. Very good. Yourself?
Good. Market's nice and hot for the last week or so. Down a little bit this morning, but it's been hot
Certainly
overall.
was. Yeah.
Mm.
It's interesting. Both yesterday and the Thursday before were the days we sort of broke up above that 9100 level before a bit of a sell-off on the Friday. A fairly decent sell-off last Friday, but only a small one thus far today. But we'll see how it plays out.
Geez, they've if stocks in their reporting have exceeded expectations, there've been some pretty big jumps up, haven't there?
Really have, yeah. I mean, looking at the banks, I know we had CBA report a full result. The others were just giving quarterly updates, but they've certainly pushed to levels well above, I think, what we would have seen as fair value and probably seen as where you'd want any client buying in. Due to, if you're looking at it from a yield return, they don't look that attractive.
No. I think you've got to wait now for some of those quality stocks. You've got to wait for a pullback before you get back into them. If you, particularly if you're chasing dividends, it's they're sort
Yeah.
of way above where you'd want to enter for now, and that might come in after the go ex-div. You never know.
Yeah, very true. I do feel that March could sort of see a bit of easing back. We were just talking earlier, and I think sort of 300 points down from here would probably be some good buying.
Yeah.
And as we go through some of these divs, we may see the market sort of certainly get back under 9,000, maybe around 89, 88.50 would be where I'd probably be a buyer of some of our blue chip stocks.
Yeah, I mean, you look at BHP at $53 odd, you could certainly be selling calls around there, and even looking
Yeah,
to potentially buy some downside protection in the index as well around these sort of levels for a bit of a
yeah,
pullback. But
yeah,
yeah,
very good idea.
yeah. I was going to have a chat about James Hardy as an example of a trade we did a while ago. If you wanted me to quickly go through that one,
Yeah, go through that. That'd be
yeah, I'll
good.
just
Yep.
fire up the screen here and show the chart. It was the clients bought in after we were looking at the US interest rates looking to drop. And traditionally, building companies that build houses and things, interest rate drops, a bit of interest in building and buying houses when that happened. James Hardy supplies the US as one of its big markets, and I think they bought in at around 36. I've got the US one open again here, but the Australian one follows the same sort of pattern.
Yep.
Bought in around 36 odd dollars, which the equivalent would have been sort of up around here somewhere. Trump started making some noises about different things with fixing interest rates and doing other things, and it sent the housing market a bit up and down in the suppliers, and the share market dropped. The share price dropped a fair bit. So when it was down at its lowest, we did what's called a repair trade, and the premium was pretty good. We were able to sell a call above its current price, and then buy a call spread with its proceeds for a premium, which then the share market, the price moved up a bit. We were able to do that again, and then this month we sold a call out of the money call again. So the clients were able to get an additional $10,000 in options premium riding this move from here to here. So they bought in at
Fantastic.
$36. Yesterday it was trading at 35, so they're still down if you look at their capital price. But with
Yep.
that $10,000, it's equivalent of $1.20 on the share price. So if they wanted to get out of it, they'd getting out for an equivalent of 38 odd dollars at a purchase price of $36. So it's a good way to show, if a stock's not performing as well as you want, you can certainly use some options to make it work a bit harder, and selling calls and selling doing a repair trade's one way of doing it.
Yeah, that ratioed nature of it gives you that sort of quicker benefit on an upside move. So yeah, the repair trade can be a great one for, when a stock's sort of down a bit, but you can see a little bit upside potential, but you want to get out of it with on that smaller move rather than waiting for the full couple of dollar move you might need.
Yeah, it certainly did. In this case, it certainly worked very well.
Yeah,
And
excellent.
yeah, I think QBE reported today, and it looked pretty impressive as well.
Yeah, really good result. It's up a dollar at the moment, the stock. And it's an interesting one. It was dragged down earlier in the week. Suncorp reported, and look, the numbers that Suncorp had out were okay, but I think the market hasn't got overly positive views on Suncorp at the moment, even though consensus targets do suggest there's a fair bit of upside still. And that probably dragged QB off a bit, but it recovered a bit yesterday. And then the result today, with a good lift in the dividend, is certainly brought some strong buying in, up 5% at the moment. And obviously, a stock we've played in a fair bit of late. I've got a couple of clients right now looking to sell covered calls in QB on this move. um, looking to extract the dividend, which is, I think, 5th of March, they go ex. It's about an 83, 86 cent div, I think. And then trying to get a bit of premium, selling some calls at some European calls so they don't get exercised pre-div. So that seems like a pretty good little trade at the moment.
Yeah, I had some clients actually buy QBE yesterday
Yep.
because QBE and Suncorp are actually very different insurers, but they, as you mentioned, they get grouped together. Like QBE's got a much broader, diversified risk profile, whereas Suncorp's a bit heavily exposed just to Queensland and natural disasters
Yeah.
over there. So,
Very true.
it's a very different insurer. So, yeah, I didn't mind that at all.
Yeah. Excellent. All right, mate. Well, I suppose the other thing we were just going to comment on is, clients being patient, for when they do re-enter the market. Obviously, we're seeing these indices at very close to record highs. I think we hit a record yesterday, mid-morning, with a few divs to come out. Obviously, we should give up 100 or 200 points from where we are here once everything's gone X, and that's probably where I would certainly start looking around for some value.
I think there's, I'd totally agree. And there's probably some opportunities for some switch trades out there. I mean, one we mentioned last week was switching out of Woolworths and into Coles. If you look at those two stocks, Woolies run really hard, Coles haven't. Those two
Yep.
stocks tend to, do this and oscillate around. So I think you'll see more of those sort of switch trade opportunities coming up in the next month or so once we get out of reporting.
Yeah, definitely. And I think it's worth mentioning, look, if we come back to the banks, and we're starting to talk about them, their yields being very, very low, where they're priced at the moment. The big question for me is, where does the next level of growth come for the banking sector? I think AI has probably helped enormously, so reducing general costs, and the banks have done very well at cutting costs. Their loan books look very strong. Obviously, we've got a full employment in our economy, so that definitely helps keep a loan book looking attractive. But when we're moving into an increasing rate market, banks on very low yields don't seem attractive to me versus, your CBA, you're getting the same yield in a cash product as you're getting, owning a bank share. And a bank share's got a lot more risk in it than a cash product. So something I think more and more investors need to look at and think, where's the next leg for the banks, and should they be taking some money out of them?
I totally agree. I mean, if you look at ANZ's result, its profit really came from cost cutting, not from growth. And with
Yep.
interest rates rising, it's got to either win back market share or get it from pure organic growth. That's going to be
Yeah.
challenging for those guys. So I
Very much.
think you're going
Yeah.
to see a bit of a rotation out of banks very soon.
Yeah, especially because we're such a mature banking market. There's
Yeah,
really nowhere the banks can grow. They've got such deep saturation in our economy already,
yeah,
and the big four, all they're doing is pinching market share from each other. Really,
yeah.
maybe
That's
a
it.
little bit from the regionals, but the big licks of market share come from ANZ pinching business from Westpac, or
That's
vice
it.
versa, and
That's it.
it's getting a lot harder.
It
So,
sure is. It sure is. Righto. Well,
right, mate.
have a great weekend. I'll talk to you again next week.
You too. Thanks, mate. See ya.
Bye.